As discussed above, China's financial system has been developing rapidly since the inception of the economic reform policy in the late 1970s. And accordingly, its financial regulatory regime has undergone a series of significant reforms to keep abreast of market developments. Despite the rapid progress, China's financial system is not without problems. If China is to fulfill its promise as the world's fastest growing economy, it is essential to address these problems with a view to developing a more efficient financial system. The first problem is structural imbalance and state ownership. 30 years on, China's transition towards a market-based economy has proven to be a huge success, and the financial system has developed significantly to support this transition. China's financial system does an outstanding job of effecting transfers between those with surplus resources for investment and those seeking funds for productive enterprises. However, since the financial system itself is in transition, there are still obstacles to the overall efficiency in allocating resources. Of particular relevance here is the unbalanced structure of the Chinese financial system. On one hand, China depends too heavily upon the banking system for capital allocation. Other financing methods through the securities markets, like bond and equity markets, are underdeveloped. Just as the table shows, in China, banks intermediate almost 75% of the economy's capital, while the figure is typically less than 20% in developed countries. On the other hand, state ownership is pervasive in the financial markets, resulting in a high level of concentration in the provision of financial services. For instance, the Big Four state-owned commercial banks form the mainstay of China's banking system, accounting for more than 50% of the total banking assets at the end of June 2008. The remaining banks are relatively small, with joint stock commercial bank and foreign banks representing only 14% and 2.3% respectively. The situation is even worse for the insurance industry, where state-owned insurance companies command more than 70% in the market. The high degree of concentration had the effect of inhibiting competition in the financial services and markets. Moreover, state-owned financial institutions traditionally favor state-owned enterprises and provide limited financing to private enterprises in China. For example, in response to the global financial crisis, China launched a massive 4 trillion yuan stimulus package, much of which has been directed towards infrastructure projects that are dominated by large state-owned enterprises. This represents an inefficiency in the financial system, since private enterprises, domestic, foreign-owned, and joint ventures are the engines of growth in China's economy, together contributing about 60% of GDP output, 68% of China's exports, and half of the national tax revenues. In other words, China's small and medium-sized private firms do more for the national economy than large state-owned firms, but get less help from the financial system, which is dominated by state-owned institutions. It follows that China needs to spur the growth of non-state-owned financial institutions to diversify the sources of funding available to enterprises in China. Of course, Chinese governments have realized the problem and are devoted to improving the overall efficiency of the financial system. The second problem is lack of regulatory independence. This is a long-standing issue associated with China's financial regulation. Although the People's Bank of China law seeks to preserve some measure of independence for the PBOC, it is in essence a ministry ranking unit under the leadership of the State Council. The senior officers need to be approved or nominated by the government. The PBOC is required to submit working reports to the Standing Committee of the National People's Congress. The PBOC must obtain the approval of the State Council before it is able to take actions on certain important matters, such as the annual supply of currency, interest rates, and foreign exchange rates. The 3 specialist regulatory commissions, namely the CBRC, CSRC, and the CIRC, may have even less independence from the government. For example, the CBRC is formally an instrument of the central government and is subject to the direct leadership of the State Council. All the chairpersons of the CBRC are appointed by the State Council and are accountable to the Premier. This is also the case with CIRC and CSRC. The lack of the regulatory independence makes it possible for the governance to interfere with the financial regulatory system to the effects that decisions are made for political gain rather than in the interest of the nations. Consistent with China's economic reform policy, it is necessary to take a gradual approach and make sure that the responses to the issue are measured. This will take time, as it involves not only standard legal and economic considerations, but also super complex social and political factors, which will evolve as the economic reform progresses. Another key problem with China's financial regulation lies in its traditional sector regulatory structure. Since China's entry into the WTO, financial modernization has been carried out on a trial basis and has made significant progress. The development is exemplified by the emergence of some large financial conglomerates such as China Everbright Group, Ping An Group, etc., which involve a diversity of institutions operating in a range of different sectors, including banking, securities, insurance, trust, and asset investment. As a result, the once sharp boundaries between different types of financial institutions are becoming increasingly blurred. Furthermore, financial innovation has created products such as sophisticated derivatives, which can't be easily accommodated within the traditional contractual forms of debt, equity, and insurance. The development has resulted in significant changes to the nature and distribution of risks in the financial system, with the risk portfolios of different financial institutions having begun to converge. Therefore, the ongoing process of financial modernization and innovation, as symbolized by the emergence of large multi-service financial conglomerates and complex cross-sectoral financial products, has significantly changed the way the financial markets operate in China. These market developments pose a serious challenge to China's traditional sector regulations, and under which regulatory responsibility is divided along the traditional line of banking, securities, and insurance. Not surprisingly, China's current regulatory structure has shown significant inadequacies in response to the changing financial landscape. In short, the mismatch between China's regulatory structure and the underlying market it regulates has increased the regulatory costs and, more importantly, has led to overlaps and gaps in regulatory coverage. Accompanied with the financial innovation is the emergence and prosperity of the shadow banking. Shadow banking refers to a diverse set of institutions and structures used to perform banking functions, however, outside regulated depository institutions. In China, shadow banking prospered after the global financial crisis, different from the shadow banking in developed countries. The rapid growth of shadow banking in China has occurred in response to China's repressive financial system and the tightening monetary policy. There were 3 levels of shadow banking in China. The first level refers to commercial banking and investment banking, including bank trust, corporation financial products, products issued by investment banks, and financing leasing companies, and insurance brokerage firms, and their products. The second part includes quasi-financial institutions such as microloan companies, financing guarantee companies, and pawn shops. The third part consists of informal financial institutions. The informal financial institutions carry out performance of financial functions and risk management outside the banking system and regulations. According to the PBOC data, shadow banking now comprises about 1/2 of all financial activities, whilst shadow banking has improved the efficiency of capital allocation. Attention is increasingly focusing on its significant risks. With the rapid development of shadow banking in China, financial disintermediation has rapidly increased potential risks, causing financial fragility and instability. Shadow banking institutions innovate many new products, but these products are not necessarily monitored by regulator sectors. It is necessary to build up a new financial regulatory system to adapt to the development of shadow banking system. The financial regulatory system must change the model of supervision from institutional regulation to business monitoring in order to create a unified financial supervision framework.